Minnesota Office of the State Auditor presents the 6-Year Rule. In this video, we will examine why the rule exists, introduce what the rule is and how it significantly changed in 2023, and identify its important details. Okay, a little background will provide important context. Normally, when new value is created by a development, it immediately becomes part of the tax base and produces a share of the tax levies. When tax increment financing, or TIF, is used, the new value created during the life of a TIF district does not become part of the tax base until after the TIF district ends. While the TIF is active, only the original value is part of the tax base, and the taxes on the new value are captured to finance the costs that enable the development. That capture might seem like a negative, and it is if the development does not need TIF. However, if the new value would not happen but for the use of TIF, and TIF truly enables the new value, then this capture of value in taxes is considered a neutral necessity that produces the greater tax base when the TIF district ends. But there is another component here beyond whether the use of TIF is appropriate or not. There is also the element of scale or extent of TIF use, both in terms of time and the scope of expenditures. TIF districts have maximum durations. Over that time, the captured value may produce a lot of tax increment. But this full potential of tax increment capture may exceed what is necessary to enable the development. Prior to the adoption of the 5- and 6-year rules, authorities were often reticent to end TIF districts early. They often sought new uses for the stream of tax increment revenues beyond enabling the initial development. This meant that value was being captured beyond what was justifiable in terms of economic rationale. The ideal scenario is to decertify the TIF district once the captured increment is sufficient to cover necessary costs. This maximizes the public benefits by getting the new value incorporated into the tax base as early as possible. The 6-year rule seeks to require this early decertification. It piggybacks on the 5-year rule, which, generally speaking, identifies the necessary costs. Let's get a little more specific about this necessary cost idea. Most tax increment, 75 or 80% depending on the type of district, must be spent on activity inside the boundaries of the TIF district, while the other 20 to 25% is allowed to be pooled or spent on activities outside the district. As such, tracking in-district shares of increment revenues and in-district expenditures, along with out-district shares of revenues and expenditures, is an important responsibility for authorities using TIF. The 5-year rule prescribes that expenditures are only regarded as in-district expenditures if they are spent in the first 5 years from the certification date or pursuant to a bond or note established within that 5-year period. Any later expenditures or obligations must fit within the limit on pooling. So as we talk about the 6-year rule, the necessary costs for which receipt of sufficient increment should trigger decertification are those in-district costs and obligations under the 5-year rule. So with this context, let's get more specific about what the 6-year rule is and how it was significantly changed by the 2023 legislature. The 6-year rule has long had two parts: a requirement to decertify when increment revenues are sufficient to pay in-district costs, and an annual limit on pooling that started in year 6 that was in addition to the overall pooling limit that applies over the life of the district. The details of the decertification requirement were changed significantly. The extra annual pooling limit was repealed in 2023 due to its limited value beyond the overall limit, low awareness, complexity, and compliance challenges. So this restriction is gone and no longer something TIF authorities need to monitor. A new component was added, however, that requires a close look. There is now a requirement to remove parcels once they are no longer obligated to pay any qualifying in-district obligation. This prevents parcels from accumulating increment when the in-district share of that increment cannot be used for any expenditures. It helps avoid the potential pitfall of improperly spending that increment, and it gets the value of those parcels back into the tax base as soon as possible. This applies to districts with a request for certification occurring after May 25, 2023, but it may be wise to act upon for existing districts to accomplish the same benefits. Let's look at how the decertification requirement is specified and how it was recrafted in 2023. Under the old law, decertification was triggered by setting aside sufficient increment and defeasing bonds, but it was unclear what constituted these actions, and such actions wouldn't necessarily occur when sufficient increment was received to pay obligations. The new law seeks to establish a more concrete formula that triggers decertification based on receipt of increment, regardless of how promptly such increments are used to pay obligations or defease bonds. Decertification is required when the applicable in-district percentage multiplied by the cumulative tax increment revenues received through the current year equals or exceeds the amount sufficient to pay in-district obligations. There are complicated details, but hopefully there is less ambiguity and better ability to plan for the proper timing of the required decertification. Speaking of planning for the proper timing of the required decertification, let's just change the greater than or equal sign to an equal sign and do some basic math. If we divide each side of this equation by the applicable in-district percentage, we can identify the cumulative tax increment revenue amount that will trigger decertification. This removes the applicable in-district percentage from the left side, and we get a formula that allows us to determine the revenue benchmark at which point decertification will be required. We can do this in year 6 because at that point, the in-district obligations and expenditures will be known and will no longer change. So identifying this revenue benchmark in year 6 will help you plan for and comply with the decertification requirement. Now, one caveat or note: because interest may fluctuate, and because other revenues may also be paying obligations and reducing the sufficient amount to be paid from the defined cumulative revenues, this may not be completely set in stone as of year 6, and therefore this math should be rechecked each year. The follow-up video on monitoring compliance explains this further. And a second note is that calculating this revenue benchmark may not be so important in the case of districts with a pay-as-you-go or pay-go note, because there is special treatment for them that affects their decertification timing. Let's talk about pay-go notes and the clarifications and special provisions for them that were built into the new law. The unique thing about pay-go debts is that they generally only obligate tax increment from specific parcels, not the whole district, as taxes on those parcels are paid. For other types of debt, any revenues of the district can be used to pay them, so the presence of sufficient increment is a good trigger for decertification in those situations. But with a pay-go, if increment is available from other parcels that isn't obligated for the payment of the pay-go, requiring decertification based on that increment would prematurely cut off a TIF district before the obligation is satisfied. Those increments wouldn't be due under the pay-go note, and ending the district stops the increment stream, leaving the note holder or developer with unpaid costs. Therefore, the 6-year rule has a two-step structure, where paragraph A of the statute requires decertification when sufficient in-district increment has been received to pay in-district obligations other than pay-go notes. Paragraph B then defers decertification until the last pay-go terminates, and there is sufficient increment to pay other in-district obligations, while also requiring the removal of parcels whose increment is no longer obligated to an in-district obligation. There will be some flexibility to that, which we'll discuss later. But let's look at an example to help clarify. Let's look at an example where one larger lot is redeveloped into a 7-parcel business park using a redevelopment district. The city issues a general obligation TIF bond to acquire the property and install the street and utilities, and signs a pay-go agreement with one developer who will demolish the property's existing building and construct a new facility on parcel 1. Specifically, the two in-district obligations include a pay-go note with a principal amount of $225,000 to be paid from 90% of the increments paid on parcel 1 every 6 months. And this note will terminate at the earlier of the payment of the $225,000 or after the February 1st payment in 2040. And a general obligation TIF bond with the following payment schedule, which will be paid off in 2031. Let's jump ahead to 2029 and look at the increment collection through that year. Here we show the total received by each parcel along with the in-district share, which is 75% for a redevelopment district, and out-district share that covers any admin or pooling. For parcel 1, of the $120,000 received, 90% went to the note holder per the terms of the pay-go note. So $108,000 was paid to the note holder, and the city used the other 10%, or $12,000, for admin costs. For parcels 2 to 7, the bond payment schedule was followed. So $320,000 has been paid on the bond, with $80,000 more due in $40,000 installments in 2030 and 2031. The remaining $88,000 of the $408,000 in-district share of revenues is sitting in the fund as a cash balance and is sufficient to make those last two bond payments. The out-district money was used for admin and pooling expenditures. Under paragraph A of the 6-year rule, decertification may be triggered because sufficient in-district increment has been collected to pay in-district obligations other than the pay-go. If that happened, though, the pay-go note holder would be harmed and would only receive $108,000 of the $225,000 owed, or at least would lose out on the remaining 11 years of payments. Therefore, paragraph B defers decertification until the PAYGO terminates. At this point, though, what good would come from leaving parcels 2 to 7 in the district through 2040 when the PAYGO note would terminate? If we jump ahead to 2040, the in-district share of increment would continue to accumulate, and the amount over $400,000 could not be used for anything, assuming the PAYGO note had no prepayment clause that would allow other increments to pay off the note early. So it is back in this 2029 to 2031 timeframe, when those parcels are no longer pledged to an in-district obligation, that the removal of these parcels from the district would be required, and the district would then continue with just parcel 1. Actually, the district in this example was created before the 2023 effective date, so those parcel removals would not be required, but it would still be a good idea because leaving them in the district would just set up a potential pitfall where if any of the additional in-district increments were spent, it would be a violation of the TIF Act that would require remedy payments. You can see how important it is to keep track of in-district and out-district expenditures, obligations, and shares of increment, and the need to annually assess whether the 6-year rule applies. Now, so far we've introduced this rule generally, and there are details that need highlighting. We'll do so succinctly here and share other resources at the end of the video that you can turn to. Let's start with the applicable in-district percentage. As we've said, the in-district percentages vary by district type and are 75% for redevelopment districts and 80% for all other statutory district types. There is, however, authority to elect in a TIF plan to allow an extra 10 percentage points of pooling if done for certain affordable housing purposes. This would reduce the in-district percentage by 10 percentage points. There is also a provision here where admin costs can switch from being considered out-district to being considered in-district if all the pooling, both the normal percentage and the extra 10%, are used for the affordable housing purposes. So applying the 6-year rule has some extra nuances here if this election is made. Moving to the cumulative tax increment revenues portion of the equation, the actual term used in statute is the cumulative revenues derived from tax increments paid by properties in the district through the end of the calendar year. This references a defined phrase and includes only the distribution of increment from the county auditor and any TIF credit reimbursements. It does not include interest earnings, sale and lease proceeds, and other revenues that are also defined as tax increment. It just applies to the increment generated from captured value. This amount will include any final settlement distributions made in the following January. Although that's after the end of the calendar year, it's for the same taxes payable year and is explicitly included. And when determining this amount, any amounts returned to the county auditor as excess increment or as remedy payments must first be subtracted. This way, the percentage of properly retained increments becomes the proper measure. Turning to the last component of the formula, the amount sufficient to pay in-district obligations, we've used a simplified expression here to introduce the rule. The actual term in statute, shown here, includes noteworthy details. Starting with this last clause, the reference to the situation we mentioned moments ago where admin costs are treated as in-district costs when all pooling is done in accord with the pooling for affordable housing, this reference assures that they are included in the amount of in-district costs. Accrued interest on obligations is included in this measure, not just the principal. And the reference here is to in-district obligations described in the 5-year rule. Although I mentioned it describing paragraph A of the 6-year rule, the simplified expression of the formula displayed so far has not called out the important detail that in-district PAYGO notes are excluded from the calculation of the time to decertify. And this term qualifying in front of the reference to PAYGOs is specifically to identify PAYGOs for in-district obligations. Any PAYGOs for out-district obligations do not factor into the analysis of sufficient revenues, and they do not cause a deferral of the decertification requirement. Understanding these details, we can apply them to our example. 75% of the cumulative tax increment revenues would trigger decertification when sufficient to pay just the $400,000 bond. The $225,000 PAYGO note is ignored. And if we switch back to calculating the revenue benchmark for our example, it would be that $400,000 divided by the 75%, or $533,333. In our example, we had the following increment through 2029, which had looked like the right timing, ignoring the detail about excluding PAYGOs. When we total the revenues for all parcels, we see the cumulative revenues were already well above that threshold. Decertification would have been required under the formula earlier. We see here it actually exceeded the benchmark in 2028. So paragraph A of the statute initially requires decertification in 2028, but the deferral in paragraph B applies in either case, and now we know 2028 is the right time to start looking at parcel removals. Which brings us to some details about the parcel removal requirement. Here we have the text of how it is specified. It starts with the timing for when it must be applied, during the deferral, beginning at the time paragraph A would otherwise require decertification. That was 2028 in our example. But there is a further timing parameter as to when it is triggered for which parcels. Remove, by the end of the year, all parcels that will no longer have their tax increment revenue pledged or subject to a qualifying pay-go note or other in-district costs and obligations after the end of the year. So strictly speaking, the parcels in our example are still pledged to an outstanding bond through 2031. While that is the strict timing requirement, it is fine to act earlier at a more logical time. And there's some further flexibility, as we've alluded to, where the parcels may be left in the district if the in-district increments from the parcels are used to prepay pay-go notes, if permitted, or other in-district obligations, or are used for the additional pooling for affordable housing purposes, as is detailed in paragraph I of the statute. We won't elaborate on those options here, just note that parcel removal can be delayed to instead expedite the payment of obligations. It might seem like a lot of details, or making this rule seem kind of intimidating in its complexity, but it is good that these nuances are actually being identified and addressed with answers. The key is to understand the overall requirements, and then explore the details when necessary. So let's wrap up with just a few other details to note. There is a grandfather provision for out-district bonds to which increment was pledged that were issued prior to August 1st of 2023. It provides that the decertification and parcel removal requirements shall not apply prior to the bond being fully paid or to fees. This only applies to traditional bonds, not interfund loans or pay-go notes, which are also technically defined as bonds in the TIF Act. There are timing parameters for when decertifications must be done and communicated to the county auditor. In a nutshell, decertifications by resolution must occur by December 31st when a pay-go note deferral applied, or by the following January 25th if there was no deferral. However, it is important to do these and to communicate them as early as possible to ensure that the county can get it on the tax rolls and prevent increment from being calculated for the following year. There is also a requirement to return any subsequent distributions if increment is not stopped in time. Also note that the 6-year rule does not apply to a housing district because increments from these districts must be used for housing activities, and housing activities are generally always considered in-district activities. And lastly, there is a provision protecting additional pooling elected in TIF plans for affordable housing, but the details of that are a bit complicated. One final note, there are some districts whose 5- and 6-year rule periods have been extended, either under statutory extensions or under special laws. So note for some districts, year 6 might actually be year 9 or year 11. And that concludes this video on the 6-year rule, but please also look for our follow-up video titled How to Monitor the 6-year rule, as well as our webinar titled 2023 TIF Law Changes. Please also refer to the statute, as well as our statement of position titled TIF 5-year rule and 6-year rule. Aside from the statute, these can all be found on our website, www.osa.state.mn.us. Thanks for watching.